Hi, welcome to the Price Action Analyst YouTube channel. I just want to do a follow-up video on the previous video I just did, which was a market update. And I just want to talk about 2007-08, the housing crisis. And the reason I want to do that is because the two seem very similar to me in terms of price action, but underlying economic fundamentals. And let me just explain what I'm talking about. In terms of price action, around July, August, the markets dipped quite heavily. But it was, the economy was fine. The market had been fine. The market had been going up for a long time. Everyone was confident. And the market dipped here. And when it dipped, there was already commentary about something being wrong in the housing sector and the related assets like the mortgage-backed securities and the collateralized debt obligations and that sort of stuff, that there was a problem in those instruments. They already knew that here. And all the talking heads on TV were like, buy the dip. Because everyone, when the market had been going up for so long, every time you bought the dip, you won. And so they were still saying buy the dip here. And indeed, even I took a margin loan out here. And I remember about the time that it approached the previous high, I remember my margin loan being up quite a bit and being, pretty happy. But what happened was price sort of just washed that previous high, and then it started to fall. And that was at the 150 level, 155, 156. And, for the next year and a half, 2 years, that market just proceeded to halve. That was the low there at 67. So why am I bringing this up? Because it's similar in that, it's different in that this fall was much more pronounced. It was much more extreme. And you'd expect that when the government does something crazy like turns the economy off for 3 months. But all the while that this market's been going up, the economic commentators that I've listened to have been talking about how the underlying fundamentals of the economy are very sick. And that goes all the way back to, it started potentially with Greenspan keeping interest rates artificially low. You had all the resulting malinvestment, and then you had the housing crisis, and the way they fixed that was just basically by printing money and putting it in the system. And so depending on who you listen to, they moved that problem from private sector balance sheets and made it a public sector balance sheet problem. And so, for the uninitiated, the entire story is summed up with the fact that the U.S. debt's at 25 trillion. And then when this happened, they've just pumped another 6 trillion into it. And the current Fed chairman's on TV talking about how, there's no limit to them printing money. And in fact, they don't print it anymore. It's just a digital currency. So when you listen to the economic commentators that I listen to, they're like, the underlying economy has serious fundamental problems that we have yet to reconcile. And when it is reconciled, it's going to look very ugly. So COVID's kind of the pin that's pricked it. And the other reason it's similar is because now the market's going up, and everyone's, the talking heads are again talking about V-shaped recovery and crazy nonsensical stuff like that. So it reminds me of 07-08, because I'm expecting this to just drop off a cliff, because as in 07-08, that underlying problem that they talked about, even though it's known here, you can get a market rally and you'll get price peel off again. The only thing that's kind of took me by surprise here is that when you get very strong price action down, I expect to see the retrace happen kind of here 50%. You know, you get this high here and you get a wash of that high and you get price peel back here. But for whatever reason, whether it's the money printing or whatever, the market has continued to rally up. And as I said in my last video, this was kind of like the last, you know, if the market had just pushed through this level, then it was either going to wash or come back, or it was going to be away. But we've got very bearish price action here, and so I think this is the beginning of the rollover here. And I think, you know, as in 07, 08, when they, even though they start throwing money at it, it's not going to stop the market from doing what it's going to do. And you know, to me, this was the bubble prick, if you like. The market's come off. It's had a resulting retrace, which has gone further than you expect. But I think that this low is going to be tested, and if the economy does slide into a depression, which I'm also kind of expecting, because you can't just turn economies off for 3 months, you know, but the resulting economic effects are going to take, you know, 6 months to a year to show up. But as those start to show up, you know, this market's at 325, and when I showed you the 07, 08, it was at 156 and it halved and it went to 70. So at 325, this has got a long way to fall. Like, I'm not saying it's necessarily going to do that, but if the market's going to just tank, there's a long way for it to go down. So just be careful. This is very similar to 07, 08 in my mind. And so, you know, I wouldn't just be crazy bullish here, especially with today's price action. To me, that's very likely the beginning of the end for this last bull run. So I'll keep you updated, but just wanted to let you know what I think and how that's similar to other things I've witnessed in the markets. Thanks a lot.